Kitco News, special coverage of the Mines and Money London, is brought to you by Sandstorm Gold Royalties.
Hello, I'm Michelle Makori. This is Kitco News coming to you from Mines and Money London. My next guest says that a new commodity supercycle is coming, driven by two mega trends, and the companies poised to outperform will have to be ESG compliant. Amanda Van Dyke is the Managing Director at Arch Emerging Market Partners. Good to have you with us, Amanda.
Good to be here.
All right, well, Amanda, as far as I was aware, we're already in a commodity supercycle. So is a new one coming, or are we in the beginning stages of one?
I think we're very much in the beginning stages of this commodity supercycle. We're at the very low end of the curve. While prices have definitely jumped and people have gotten very excited by that, I think there's a lot more to come. This is just a taste of, I believe, what is going to come in the next 10 to 20 years of this cycle playing out.
Which commodities in particular do you see having the most room to run here?
The battery metal suite is great. So nickel, manganese, graphite, they're heavily used in the EV space. But I think the biggest winner, hands down, is probably going to be copper. Copper, there is no part of the new energy transition that isn't dependent on the copper. And if I had to bet on just one, it would definitely be Dr. Copper.
Dr. Copper, do you have a price target for copper for the next 5 years or so?
We're definitely going to hit $5. There's just no way around that. And depending on how well exploration and development goes for new copper, it could hit in the short term. In the interim, it could probably go up to 10 if there are supply crunches, which could happen if the industry isn't developed well enough to make sure that there's a steady supply coming on. So the interim short-term supply-demand imbalances might cause it to go up in the short term. I don't think long term, but in the short term to $10.
Wow. Okay. Let's talk about the mega trends driving this, because we mentioned clean energy, but there's another trend that you see facilitating this next commodity supercycle. What is that?
I truly believe that urban development is still going to play a much bigger role than a lot of people realize. The last commodity supercycle in the early 2000s was driven by China, and about 500 million people coming out of the countryside and sort of rural, relatively poor, commodity non-intense lifestyles and moving into the cities and moving into the middle classes. And that economic development is the biggest driver of commodity consumption in the world. And once those people have moved into the largely urban middle classes, their commodity consumption remains constant. They don't sort of start, you don't build roads and then not need metals going forward. The intensiveness of Western developed living is what everyone in the world strives for. And once people get there, they don't stop consuming, they continue consuming. So it makes the baseline level of metal and mineral requirements very, very high. And the reality is, while Asia has done a great job developing in the last 20 years, there's still a huge number of people in Asia generally and in Africa that are looking to move up the economic development cycle.
All right, so urbanization, particularly in Asia and Africa, and a rising middle class, one factor that's going to drive the commodity supercycle, and as we just discussed, clean energy and the push to decarbonize, another factor here. But yet you say that this commodity supercycle is going to be different than all the other ones prior to this one. Why is that?
It goes back to the last supercycle. The last supercycle was metals at any cost. The drive to build cities and develop was relentless. And unfortunately, the environment and the communities where these metals were found paid the price for that. And I think that the world has decided that while they want an energy transition and while they want a better quality of life for a much larger number, if not all the people in the world, they don't want it at any cost. That quality of life, clean energy isn't worth having if it's not actually clean. And the consumers of the world, especially in Western markets, have been very clear. They want a higher quality, more transparency, and more sustainability in in all of their products. They want a transparent passport, as it were, a sustainable passport for all of the goods that they consume. And they've demanded of their companies and of the governments of the world to ensure that that happens. And my belief is that it's only the metals and mining companies that can get that social and environmental license to operate, that can produce sustainably, that are going to be able to, or invited, frankly, to participate in this next super cycle.
All right, so Amanda, we certainly know that ESG is a concern for the majority of Western governments, but in terms of consumers, do we know that they really, really care about how the materials for their iPhones or cell phones are sourced? Is there really sufficient data to show that a consumer is willing to pay more for equipment that has been sourced on a sustainable level and an ESG friendly level than otherwise?
I think there is. If you look at large companies like Apple and Google and Ford, they've seen a huge pushback from consumer groups and lobby groups as well as others that really attack them. Do you remember, I'm dating myself here, but when Nike got in trouble for using sweatshops 20 years ago, the outcry was huge, and the companies were forced to change the way they sourced and supplied what they did, their running shoes. The same thing is happening for all producers of goods in the West. If they can find out that you are sourcing these things in a bad way, I mean, Apple paid a huge price when there were articles about, child minors in the Congo potentially getting their cobalt into their phones. And they completely changed all of their buying and all of their sourcing and all of their transparency on their batteries throughout their supply chains. Tesla has made a huge effort to ensure that transparency, because there's no point in having a clean option if it's not clean in all ways.
Right.
And on top of that, some of the new sustainability regulations that are coming out, I don't think Ford and Daimler Chrysler have both signed on to a new IRMA certification initiative. So from 2025 onwards, if you can't prove the sustainability and the ESG license to operate, as it were, for your mining production, you're not allowed to put your metals into a BMW or a Ford.
From 2025, what is the regulation there?
There's something called IRMA, IRMA, International Responsible Minerals Association. And they've produced a certification for producing miners only that has a transparent certification to show the complete supply chain of how your metal got into their car. And if you can't put that certificate on your metal, it's not allowed to go into the Ford or Daimler Chrysler supply chain.
So these decisions made at the corporate level then?
Yes, at the corporate level. But they wouldn't be making these decisions, these very costly decisions, right, unless they knew without fail that this is what their consumers wanted. I'm not sure that people necessarily want to pay, more money for their cars. Actually, I know for a fact that they don't. But they want to not have that taint of social irresponsibility even more than they don't want to pay more for it. And they've proven that. Companies that have Rio Tinto, unfortunately, is a very bad example. But Rio Tinto's share price fell like 30% when they blew up during their mining operations, native and indigenous burial sites. But on the other side, the flip side is, if you don't have a social license to operate, your company will be punished. And that is absolutely true. Your share price will tumble. But on the other side, companies that rate well from an ESG perspective, right, on average, trade 10% higher than their peers.
And that's exactly the focus of my next question. Are we seeing investors really looking at ESG compliance and rewarding, if you will, companies that are more compliant?
Absolutely. So yeah, it's on average 10%. A good versus an average, just an average versus the average, good and outperformers, top quartile sustainability performers, trade 10% higher. That's the average though. The truth is, if you have a bad rating, you'll trade at a negative discount. You will trade at a significant discount to market if you can't prove your ESG credentials or you do something bad. And that's every day that becomes more apparent. And every day, the gap between companies that have a good ESG license to operate and those that don't is widening.
So ESG compliance in the mining sector is going to be an indicator of stock performance.
Absolutely, no question.
And with that in mind, are there any particular mining equities that you've looked at that you see benefiting from being ESG friendly, if you will?
I think there are a lot of companies that have shown a great license to operate. If you want to look at the sort of big cap mining companies, Anglo American has really been a pioneer in establishing a social license to operate and changing the IRMA compliance, the IRMA certificate I was talking about earlier. The first company to go through the accreditation process from the major miners was Anglo American, and I think that's showing in their share price. In addition to that, I can give a smaller example, a company that we just invested in. They IPO'd on the Australian market about a month ago, and the share price went up 200% on the first day because they made ESG credentials and being a sustainable net zero supplier of graphite their priority. I mean, there's a lot of graphite companies out there, but those that will be able to achieve net zero, the market gives them an immediate reward.
So from an investor perspective, how can one capitalize both on the commodity supercycle trend as well as the push towards being more ESG compliant?
I think you have to do your homework. There's no avoiding doing your homework. Look at the companies you're investing in and try to figure out if they are just paying lip service and greenwashing, or if they're making tangible and demonstrable efforts to ensure they have an environmental and social license to operate. Do they have a good relationship with the community in which they operate? Are they taking care of the water and the soil and the flora and fauna in the regions in which they operate? And do they have CSR programs that they can actually show you, that aren't just pictures? Monitoring is becoming increasingly important. We're about to start reporting on carbon per pound and per kilogram of what we produce. And I think you'll find that there's going to eventually be an index. Companies that are in the position now to declare what their carbon footprint is that they're making an effort. But eventually, the lower carbon producers versus the higher carbon producers will perform better. Those companies that can achieve net zero faster,
right,
those companies are going to outperform.
So you see a scenario where a company issues a report that shows that it has net zero carbon emissions, for example, and is positively ranked by one of the frameworks for ESG, and then potentially see a pop on the stock price.
Absolutely. Yeah, no, that it's already started. Those companies that can rate, there's a lot of ESG indexes out there, but those that rate higher on any ESG index trade at a higher premium to their peers. That's already happening. And I think increasingly coming out of Glasgow and COP26, or you're going to see, they all have different ratings. Everyone's like net zero by 2050, 2060, 2030. The sooner they can achieve net zero, the sooner they will be trading at a premium. And that's also there because carbon credits are real. Carbon credits are happening. So if you're at net zero, the faster you're there, the faster you get the carbon credits, the faster you're making money. I mean, those carbon credits translate into money and they're worth something. So if you're just going on old-fashioned metrics like EBITDA, the EBITDA of low carbon emitters is going to be higher than that of high carbon emitters who have to pay a tax essentially on how much carbon they produce.
All right, so there is investment potential in looking out for ESG-friendly mining companies, and not to mention that it's good for the planet as well.
It's win-win.
All right, Amanda, thank you so much for joining us. Amanda Van Dyke, really appreciate it. Thank you.
Thank you.
Kitco News, special coverage of the Mines and Money London, is brought to you by Sandstorm Gold Royalties.